2 weeks ago, while markets obsessed over silver breaking $100, the US government quietly activated a legal weapon that will reshape precious metals markets more violently than any price chart you're watching. On January 14, 2026, President Trump invoked Section 232 of the Trade Expansion Act, granting himself unilateral authority to restrict imports and establish price floors for minerals deemed critical to national security. Most investors have no idea this happened. Those who noticed dismissed it as standard government paperwork. Both groups are about to learn an expensive lesson. When Washington declares materials strategically essential and authorizes economic warfare to secure domestic supply, technical analysis becomes irrelevant. Here's the mechanism. 16 minerals received critical designation. The White House now has 180 days, ending July 12, 2026, to negotiate supply agreements with foreign producers. If negotiations fail to guarantee reliable material at prices sustaining American mining operations, the administration gains authority to impose tariffs or mandate minimum import pricing. Not suggested pricing. Mandatory floors enforced through trade law. Silver isn't named in the proclamation. That's the trap. When you trace supply chains for the designated minerals, rare earths, lithium, cobalt, germanium, every processing facility, every manufacturing line, every industrial application requires silver conductivity. They've mandated a domestic industrial build-out where silver is the universal input nobody's accounting for in their demand models. The strategic objective is brutally simple. For 30 years, America extracted raw materials, shipped them to China for processing, then purchased finished products at global prices. This created complete dependency on foreign refining capacity that Beijing can weaponize instantly. Section 232 reverses this through price protection, making domestic operations profitable regardless of Chinese market manipulation. Now overlay this policy architecture onto silver markets already consuming 200 million ounces more annually than mines produce. Inventories depleted to crisis levels. Industrial demand exploding through AI infrastructure, EV mandates, renewable energy scaling. You're implementing price floors specifically designed to prevent crash cycles in markets already experiencing structural shortages. We're 13 days into the 180-day window. That leaves 167 days until policy implementation becomes mandatory. But sophisticated capital isn't waiting for July. Repositioning is happening now because professionals understand what most investors do want. This isn't volatility, it's regime change. The question isn't whether silver markets transform. The question is whether you recognize it before prices reflect the new reality. Section 232 only matters because of who it targets. China controls 98% of gallium production, 60% of germanium, 90% of rare earth processing. These are not competitive advantages. These are monopoly positions built deliberately while American facilities closed under environmental pressure and price competition. The Commerce Department investigation concluded U.S. reliance on Chinese processing creates untenable strategic vulnerability, requiring immediate correction through economic force. Beijing knows exactly what's happening. They've watched these trade war scenarios before. If America successfully builds tariff-protected domestic capacity with guaranteed price floors, Chinese leverage evaporates permanently. Their optimal counter-strategy isn't cooperation, it's market destruction designed to kill American projects before protective mechanisms activate. History provides the playbook. When the US attempted rare earth processing in 2010-2012, China flooded markets with below-cost material until American operations went bankrupt. Then they restricted exports, spiking prices after domestic capacity had closed. Economic warfare executed through commodity manipulation. Expect identical tactics now at larger scale because stakes are higher. This creates a 6-month volatility window where every Chinese action generates market chaos. If Beijing floods silver markets to crater prices before July, temporary crashes trigger, but industrial consumers panic buy inventory before restrictions hit. If China restricts exports to force concessions, prices spike, causing emergency stockpiling that exhausts available supply. Either scenario produces identical outcomes: extreme volatility and physical shortage conditions. For manufacturers, this creates impossible decisions. Stockpile now at elevated prices and absorb carrying costs, or wait for potential crashes and risk complete unavailability when production lines shut down. Sophisticated operators choose stockpiling because operational interruption costs exceed inventory expenses by orders of magnitude. Solar manufacturers losing 3 weeks of production because they can't source silver lose more revenue than 5 years of inventory holding costs. When industrial stockpiling begins at scale, spot markets convulse. Available supply was already in deficit before policy-driven demand entered equations. You're adding government-mandated build-outs, strategic reserve accumulation, and panic buying to markets that couldn't meet existing demand. The mathematical outcome is guaranteed. Prices must rise until either demand destruction occurs or new supply materializes. Industrial applications can't substitute away from silver. Physics doesn't allow it. New mines require minimum 3 years to develop. Geology doesn't allow faster. That leaves only one equilibrium mechanism: substantially higher prices sustained long enough to justify investment in new production capacity. We're not discussing whether this happens. We're discussing whether you're positioned when it does. We're going to break down the critical disconnect between the paper market, that's your futures, your ETFs, and the hard physical reality of supply and demand. Let ES start by dismantling the most dangerous assumption in market psychology right now: the idea that higher prices will automatically and quickly bring new supply online. This shows a fundamental misunderstanding of both mining economics and the regulatory landscape. The key to this entire situation is a provision in Section 232 that almost everyone is underestimating: permit streamlining. When a project is designated as critical infrastructure, federal agencies like the EPA and the Army Corps of Engineers have to coordinate to meet national security objectives. What does this mean in plain English? Permit timelines, which normally eat up 60 to 70% of the time it takes to develop a mine, are about to compress dramatically. Environmental reviews that used to take 4 to 6 years will be fast-tracked. Legal challenges from opposition groups, which could add another 2 or 3 years of delays, will likely be dismissed under national security determinations. So, projects that would have taken 8 to 10 years to get going might now reach production in just 3 to 4 years. Think about places like Nevada, Idaho, and Alaska. They have proven silver deposits just sitting there, undeveloped, because at historical prices around $30 an ounce, it just wasn't economical. They couldn't compete with foreign production. But what happens at $111 an ounce with government-backed price floors preventing those brutal collapse cycles? The economics are completely transformed. Companies with mothballed operations will restart. Developers with preliminary plans will race towards construction. And exploration companies will suddenly find the funding they've been searching for. But here is the critical gap. Even with this new, streamlined permitting, a brand new project still needs at least 30 months from approval to its first ounce of production. Restarting an old facility takes about 18 months. In major expansions, you're looking at 12 to 14 months. The bottom line is, no significant new supply is going to hit the market before the third quarter of 2027 at the absolute earliest. Realistically, for most of these projects, we're talking about the second quarter of 2028. Meanwhile, industrial demand for silver is growing every single quarter. AI data centers are consuming terawatts of power. EV production is scaling towards 50 million cars a year. Solar panel installations are mandated by renewable energy policies. And defense manufacturing is ramping up amid global tensions. Every single one of these sectors is silver intensive. Every single one is experiencing double-digit growth. And every single one is operating in a market where new supply is still years away. This timing mismatch creates a perfect storm where surging demand crashes into a wall of fixed supply with no relief valve. When it takes years to bring on new production, but demand is growing by double digits annually, price becomes the only thing that can balance the equation. And for strategic materials like silver, where substitution is physically impossible, higher prices don't destroy demand. They just get absorbed as a higher cost of doing business because shutting down a factory costs a lot more than paying up for materials. This inelastic demand has historically led to massive price spikes that overshoot equilibrium dramatically before they eventually correct. Now, let's talk about the structural time bomb itself, the thing that could turn an orderly price adjustment into a catastrophic dislocation. About 95% of all silver transactions happen through paper instruments: futures, ETFs, allocated accounts, you name it. This entire architecture is built on a fractional reserve system, where only a tiny fraction of the outstanding claims are actually backed by physical metal. Under normal conditions, this works just fine. Most people just want price exposure. They don't want the hassle of taking delivery and storing physical bars. The COMEX exchange has delivery mechanisms, but 98% of contracts are settled financially for cash. The system works because you never have everyone demanding physical delivery at the same time. That is, until a government policy creates the exact incentives for that to happen. We got a little preview of this back in March 2020. The pandemic triggered a supply panic, and demand for physical delivery spiked. Physical premiums shot up to $8 over the spot price, while the paper price on the COMEX traded as if nothing was wrong. The markets completely diverged because paper and physical are not the same thing, even if they're supposed to be pricing the same commodity. Paper was trading at $18, while you couldn't find a physical coin or bar for less than $26. That $8 spread lasted for weeks, and that was just a temporary panic with no government mandates behind it. Now imagine a sustained shift in behavior driven by Section 232. This policy explicitly incentivizes owning the physical metal. Processing facilities will need guaranteed supply. Defense contractors will require secure inventories. Manufacturers will want strategic stockpiles to protect them from trade disruptions. These are not players who want synthetic exposure. They will demand allocated storage or direct delivery of the metal itself. As these demands for physical metal increase, the registered inventories at the COMEX will start to drain. Once those inventories fall below a critical threshold, delivery delays will get longer. When the delays become intolerable, users will start to panic and overorder just to be safe. That overordering will accelerate the depletion of inventories, which triggers more panic. It is a vicious feedback loop that intensifies until the exchanges have to make an existential decision. Either continue allowing deliveries and risk running out of metal completely, or implement emergency measures. What are these emergency measures? Things like declaring force majeure, which ends their obligation to deliver. They could force mandatory cash settlements or drastically reduce position limits. Each one of these actions is a giant red flag, signaling that getting physical delivery through the official channels is no longer reliable. The very thing Section 232 was designed to prevent. And when the COMEX can't deliver, where do consumers get their silver? They'll have to go to spot dealers who will be charging massive premiums reflecting the true scarcity. Or they'll go directly to the miners and negotiate prices, or sign bilateral agreements at costs that are far, far higher than any paper quote you'll see. The policy explicitly prioritizes domestic physical supply through tariffs and allocations. So if import restrictions limit foreign metal, and domestic production is getting allocated to defense and other strategic industries, then commercial consumers are going to face a severe shortage, regardless of what the paper price says. You cannot manufacture with a futures contract, you cannot build a solar panel with an ETF share. You need the actual physical metal in a deliverable form. And when availability, not price, becomes the real constraint, markets reprice violently. Paper claims will settle at prices that have no relationship to the actual cost of replacing the physical metal. So if this analysis is even close to correct, how you position yourself becomes absolutely critical. Most people will make predictable mistakes. They'll buy ETF shares, futures contracts, or mining stocks thinking they're properly positioned. But in a policy-driven supply disruption with real physical constraints, paper and physical are not equivalent. Let's look at ETF shares. They are claims on custodial metal governed by a prospectus that was designed for normal market conditions. When physical premiums spike during a squeeze, the redemption mechanisms break down. You can't just cash in your shares and get metal at the net asset value when dealers are charging 20 or 30% premiums. You'll get a cash settlement at the paper price, while the physical metal trades at a price you'll never be able to capture. Futures contracts settle financially 98% of the time. In a squeeze, the exchange will just force a cash settlement. You get the paper price on the settlement date, regardless of what the physical premium is. If COMEX settles at $115, but dealers are quoting $145 for delivery, your contract pays you $115. That $30 premium, the one that represents the actual replacement cost, just evaporates. Mining stocks give you leverage, but they also introduce a whole host of other equity risks: management competence, political uncertainty, operational screw-ups, capital structure. You're buying a company that produces silver, not the silver itself. In a true dislocation where availability is the main constraint, stocks can actually underperform if the companies can't sell their production at the true replacement cost because of old contracts or bad hedges. This leaves us with one clear choice. Physical metal in your possession, or an allocated storage with specific bar identification, is the only position that truly captures those physical premiums during a disruption. When Section 232 creates allocation priorities, when the defense industry secures multi-year supply agreements, when panic buying exhausts dealer inventories, it's the physical holders who can demand premiums that reflect the true cost of replacement. The paper market will settle at whatever price the exchanges decide. That small premium you pay today for physical silver over the paper price, usually around 3 to 8%, is your insurance policy against this divergent scenario. And given the policy framework, the demand trajectory, and the supply risks we've discussed today, it looks to me like that insurance is dramatically underpriced. January 27th, 2026. Section 232 proclamation is 13 days old. Negotiation window ends July 12th. Between now and then, every development generates volatility as participants reposition for post-July reality. But real impact doesn't wait for implementation. Industrial consumers are already adjusting procurement. Defense contractors are securing agreements. Mining companies are reactivating projects. Smart capital isn't waiting for confirmation. They're positioning while crowds debate whether this matters. What we know with certainty, the U.S. government declared domestic metal production a national security priority. They authorized tariffs and price floors. They created pathways for expedited permitting. They established frameworks for domestic allocation. They did this in markets already experiencing multi-year deficits where demand grows exponentially while new production requires years. Variables we can't predict. When China floods or restricts, when industrial panic buying begins, when COMEX inventories reach critical depletion, what premiums emerge when markets diverge. Timing and magnitude remain uncertain, but directional outcome is mathematically guaranteed by structural imbalances the policy creates. The window to position at rational pricing is closing, not because silver goes to the moon tomorrow, but because pieces are falling into place faster than most recognize. Sophisticated investors aren't waiting for mainstream confirmation. They're positioning now while premiums remain contained, while inventory exists, while crowds debate sustainability. Tuesday, January 27th, 2026. The 167-day countdown is running.